Good day, subscribers. Thank you so much for joining me today on the Financial Education channel. So today we are talking about what is a hedge fund. Man, don't we all wish we were hedge fund managers? We'd all be millionaires and billionaires and be sweet. But what exactly is a hedge fund? A hedge fund is a group of accredited investors that pool money together, and that money is managed by the general partner, which is formerly known as the hedge fund manager. Holy smokes, I need to learn how to talk today. So, why do you have to be an accredited investor, and what is an accredited investor in the first place to invest in a hedge fund? It is because hedge funds are very lightly regulated. So, in order to invest in it, you need to be someone that's very experienced and someone that it's going to be hard to take advantage of because your financial knowledge is just kind of up there. You're not just a beginner or whatnot. So mutual funds are very heavily regulated, and there's only certain things they can do. Hedge funds, on the other hand, are not. An accredited investor is someone that has income of more than $200,000 per year, or someone that has a net worth of well over $1 million per year. And that is how you become an accredited investor. So basically, you're doing pretty well financially in life that you can take some risks in a hedge fund. Now, hedge funds are more risky than mutual funds. They'll take bigger risk on stocks. They'll allocate more assets toward one company than like a mutual fund is. A mutual fund, they try to more like split things up and try to diversify your risk. A hedge fund will go heavy on something. And then it's called a hedge fund because sometimes they'll hedge their bets. So picture this. You put a ton of your money, you put 20% of your money all in one stock. You're very heavily invested in that. You can minimize your downside risk. If you do something like you buy, a tenth of that money you use to buy put options on that stock. So just in case that stock drops substantially, your put options will then be worth a great deal of money. Now, if the stock goes up, that's also great because that's where the majority of your money is. So you're going to make a ton of money on that money. You'll lose everything on those put options, of course. They'll be pretty much worthless, but at least you minimized your risk to a certain extent. Now, a hedge fund manager, they get 2 to 20%. What does that mean? If the performance is flat for the year, they don't get you even 1% of a gain, or the hedge fund loses money, they still get 2% of whatever is in the hedge fund. So they still get 2% of it. Now, if they perform great and there's lots of profits, then they get 20% of whatever the profits are. So imagine having $1 billion and you make that $1 billion, say you double money, you had just an extraordinary year. So you double the money that was pooled together there as a hedge fund manager. So you had $1 billion, you made another $1 billion. You get $200 million of that $1 billion profit. So you can see how these guys make insane amounts of money, and some of the big guys still have $100 billion under assets. So there's certainly a lot of money to be made if you are a hedge fund manager and you are a hedge fund manager of a very big fund. But that is basically the simplest way possible of what a hedge fund is. It's money pooled together by accredited investors. There's lots of risks taken. They're not heavily regulated. Hedge fund managers make 2% no matter what. They make 20% of all profits. That's really about it to it. If you enjoyed this video, it was easy to understand, give it a thumbs up. If you didn't, then don't watch it again. But thank you guys. Subscribe. Have a great day.